In May 2025, the US Senate passed the No Tax on Tips Act, a bill that seeks to exempt up to $25,000 in cash tips from federal income tax for employees earning under $160,000 per year. This move has sparked excitement in the service sector and concern among tax professionals and economists alike. What practical implications does this law have for employees, employers, and the broader tax system? In this article, we break it down clearly and in detail. What is the No Tax on Tips Act? This bill, introduced by Republican lawmakers and supported by former President Donald Trump, aims to reduce the tax burden on millions of service workers. The law proposes a federal income tax exemption on up to $25,000 in cash tips per year applies only to workers with a total annual income under $160,000. Tips must be voluntarily reported by the employee, introducing a level of trust between worker, employer, and the IRS. At the time of this writing, the bill has passed the Senate and is awaiting review and vote in the House of Representatives. How does it benefit workers? For millions of workers who rely on tips, waiters, bartenders, baristas, hairstylists, delivery drivers, and more, this law could mean immediate financial relief. Key benefits include more take-home pay. Workers will keep more of what they earn without the federal tax burden on a large portion of their income. Less financial stress. Those with lower or fluctuating income will have more flexibility and breathing room. Encouragement of voluntary reporting. Although the law offers tax relief, workers are still required to report their tips, which may improve IRS compliance while reducing fear of audit. However, important questions arise about whether this could reduce future Social Security or Medicare benefits, which are based on taxable income. Implications for employers. Employers aren't left out of the equation. While the bill appears worker-focused, businesses will need to review payroll and accounting systems, especially how they capture and report tipped income. Clearly differentiate tax-exempt tips from other forms of compensation. Possibly prepare for increased IRS scrutiny around the accuracy of reported tips. That said, businesses could also benefit from improved employee retention as workers keep more of their earnings, fewer workplace disputes related to tip sharing or underreporting, a competitive edge in recruiting talent in tip-heavy industries, risks and controversies. While well-intentioned, the law raises several concerns. Could it increase informality or abuse? Voluntary reporting opens the door to exaggerated or false tip claims. Is it fair? Some argue the law favors tipped workers while ignoring others with irregular income. Federal revenue impact. Reduced IRS collections could affect public programs funded through federal income taxes. Final thoughts. What should you do? Both businesses and employees should stay updated on the law's progress through Congress. If it passes, this change could affect tax filing strategies for both individuals and corporations, internal tracking and reporting of tips, long-term financial planning for those in service-based industries. At FAST CPA and consultants, we're closely monitoring this legislation and preparing guidance for our clients in the hospitality, food service, and beauty sectors.